Fellow traders, James Stanley with StoneX and Forex.com. It was a wild week in the US dollar. The dollar came into last week holding on to that sell-off that had started the Friday before, and there was very much a continued drive towards that dollar yen carry unwind theme, at least initially. That lasted through Monday through Tuesday, but then something happened on Wednesday that began to turn that around, and then something else happened on Friday that helped that to continue turning around. And I think this is something that's going to have a pretty large bearing on that in the weeks and maybe even months ahead. But with that said, next week's going to be pretty big. We have the nonfarm payrolls report out of the United States. We have the European Central Bank rate decision, which I think both could have a pretty big pull on USD price action. So I wanted to look at this from a few different perspectives. I wanted to dice this up around US dollar strategy, looking at a few different components behind what I think could be really pressing as we go into next week and beyond. So let's get to the chart and start taking a look. So again, first and foremost, the dollar is a basket of underlying currencies. So it's not one of those situations like with gold or with stocks where it's just a binary. Do you want to buy or do you not want to buy, and up or down? It's not like that. It's a little bit more nuanced. 57.6% of the DXY basket is the euro, which is an outsized allocation. And you can see this weekly bar in euro dollar, not very friendly if you're a bull. This is an inverted hammer formation where bulls had an open door to run with a break. Like I said, Monday and Tuesday, we had that downside run on the dollar. It turned on Wednesday, continued turning into the end of the week. Most of that weekly range up in smoke. And now we just have this as an upper wick. If this did finish in red territory, we would have a bearish pin bar to work with. Those are a little bit more attractive for reversal potential. We don't quite have that, but the upper wick there is notable. Now, like I said, the European Central Bank rate decision, I think, is going to be a pretty big item here. And this really speaks to a unique aspect of currencies in the macro overlay, which is currencies are the foundation of the global economic system. The only way to value a currency is with another currency. So if you're going to see the dollar get weak, we're probably going to need to see something like the euro get strong or the Japanese yen get strong, which I'll get to in one moment. But with the euro being 57.6% of the DXY basket, logically speaking, if we see that sell-off in the dollar, similar to what happened in the first half of last year, the euro is going to go along for the ride. But here's where the plot thickens. As the euro gets more expensive, that shifts things in the European economy. That is pressure on inflation. It's pressure on growth. It makes it more difficult for European companies to compete with imported products, especially from somewhere like China. And this plays through in the economy because that strain, that additional strain of European companies having a more imposing backdrop to compete in their own economy leads to lower sales, slower growth, less employment, et cetera, et cetera, et cetera. So that's why, by and large, central banks want to strike a degree of balance or stability in their currencies just to keep matters as somewhat stable so the fiscal policy, fiscal growth initiatives can do their job, do their goal. Well, when we have a move like we've had in the euro, where euro dollar goes up to a 120 print, that is something that puts the ECB in a really tough spot, where they're looking at the very real prospect of flexibility being taken away from them in the future. As a more expensive euro makes it more difficult for European companies, for the European economy to continue to grow. And eventually, this is something that could actually necessitate rate cuts that eventually can play out into weakness into the euro and the euro dollar pair. We're not quite there yet, but that European Central Bank rate decision on Thursday is going to be widely watched to see if Lagarde and the ECB try to talk down the single currency. Logically speaking, it's something that one is probably going to expect her to do, but she's, let's say, unpredictable at times. So that's something we're going to have to hold out and wait for Thursday to see. Another item that I think matters a lot here, and this is something we saw develop quite a bit around the US over the past week. This thing is the dollar yen carry trade. Now, again, the dollar is simply a basket of underlying currencies. 13.6% of that basket is the Japanese yen. It's the second largest component behind the euro. So it sounds outlandish. I'll give you this, that the 13.6% component could be the main driver of the whole basket. But when you look at it like this, and I'm simply going to compare long-term dollar yen to DXY. So I'm just going to add the DXY basket here over that same period of time. And we could see where traditionally there's going to be a shared flow between the two, right? Because after all, the dollar is the numerator and the dollar yen quote. But especially in 2021 and 2022, these begin to diverge and pretty wildly. And the reason this is so is because of Japanese yen weakness. The policy in Japan was to keep rates really low, even as the Fed was lifting rates. And what this did was it created a massive amount of demand to go to Japan for those low rates. And so if you're a hedge fund and you can go to a Japanese bank and you can borrow when central bank rates are at 0%, even as the Fed's at 4 or 5% with overnight rates, there's a spread in there. And all you got to do is get a loan in Japan, invest it in the US, pocket the spread. Now, the problem is the currency. Because if you're getting that loan in Japanese yen, you are in essence long yen. And if the yen is getting upside down from this divergence in monetary policy, well, then all those profits from the spread could go up in smoke. So you hedge that risk. You hedge that risk by selling in the marketplace, buying another currency like the US dollar or maybe the euro or the British pound, but likely the US dollar, as we can see here. And that's what helps to explain this divergence. The whole reason this matters right now is if we look at how the dollar has held up on a relative basis, especially since Trump took office last year, a lot of this holding up can be explained by the Japanese yen weakness that Trump has very much called out many a times. As a matter of fact, earlier in the week, on Tuesday, he was asked after the massive sell-off that it hit dollar yen that we talked about in last Friday's video, but held through Monday and even through Tuesday. Trump was asked about that. He's like, what do you think about US dollar weakness? He says, I think it's great. Which is, if you've been watching these videos, that's not surprising. He's cheered dollar weakness numerous times. He's been very vocal about it. And it makes sense as to why. It's the same reason that Japan wanted a weak yen. To make it easier for exporters, for Japanese exporters to sell products elsewhere. It's the same reason that China wants a weak yuan. It makes it easier for Chinese companies to export products. It makes it easier for them to do business overseas. It's a strategy long accused or called beggar thy neighbor growth. And in the US, where we're the reserve currency, it's almost as if policymakers have been avoidant of going down that line. It doesn't seem as though that's a problem for Trump. It's something he's been talking about. Like if you go back to last July, again, comment we talked about in these videos, he said something along the lines of when you have a strong dollar, it's good for inflation. That's about it. You can't sell anything. It's hard to sell trucks. It's hard to sell products overseas when you have a strong dollar. And so this really speaks to the fact that each time we've had one of these pops in the dollar, you've seen Trump come out with a headline like who he's going to nominate for Fed chair, or that Jerome Powell's a nincompoop, or that Jerome Powell should have cut rates. He said it again this week. Powell should have cut rates. This all speaks to Trump's desire for a weaker dollar. Now, that comment that Trump had on Tuesday, it had a sizable impact in DXY. I mean, we could see where the dollar, and I looked at this in a webinar at the time, where the dollar, when we came into the week, I mean, we were already veering into oversold territory on Monday. But Tuesday, when that comment came in, you can see where the dollar gets hit hard and aggressively. When Trump cheers on, he says it's great that US dollar weakness is showing in the way that it did. USD got more oversold on the daily chart than at any point in 5 years. We got to go back to December of 2020 to see a US dollar oversold reading on the daily to that same degree. That also is right around the time that the dollar marked a really significant major low. Now, RSI is not a good timing indicator, so I'd caution you against calling a reversal just on that basis alone, but it does make it more difficult to chase it lower. Again, exactly like I talked about in the webinar on Tuesday. And so far, we've seen a pretty visceral bounce from that. But that bounce isn't just from RSI. There was a couple of things that were happening. Again, let's go down and examine this on a short-term basis. On Wednesday, there was a comment. Wednesday was Fed Day. But I think more notable than anything that happened on Wednesday is what, and again, talked about this in the video on Wednesday night, Thursday morning, a comment from U.S. Treasury Secretary Scott Bessent when he said that the U.S. did not intervene in dollar yen. And you can see I mean, we could even chart this on like a 4-hour chart, the way that it came in on Wednesday ahead of the Fed, right in there, right? Now, the dollar did pull back after the Fed, but notice we hold a higher low, we go right back. And then Friday, something else happened. On Friday, Kevin Hassett, a noted Trump economic ally, had a comment where he said, there are great things about a strong US dollar. Now, you can read this in a couple of different ways. And first, let me go back to that Besant comment. Besant did not need to address this. If Besant wanted to see more USD weakness, he would have not commented. He would have kept it like to a Japanese comment of, we don't comment on market interventions. We don't comment on singular market matters. He would have just avoided it altogether. The fact that he did comment on it told you that he wanted markets to know that they weren't directly intervening in dollar yen. He didn't have to do that, but he did. Why? On Friday, Kevin Hassett, with that comment, could read this in one of two ways. Either Kevin Hassett was going off the reservation and refuting what his own boss said. He was, in essence, disagreeing with Trump publicly. But that doesn't seem like a Kevin Hassett kind of thing to do. As a matter of fact, it seems as though Kevin Hassett was, by design, walking back that comment from Tuesday that Trump had and stating there's a reason they don't want the US dollar to melt down. That reason, I think, is really pretty clear when we look at that long-term Japanese yen carry trade. Again, if we look at the yen on a long-term basis, we're still more than 50% above those early 2021 values. Now, this trade, in essence, is a form of leverage because, again, if you're a hedge fund, you go to Japan, you get a cheap bank loan, and you can invest it somewhere else. You can invest it in U.S., you invest in U.S. rates, you can invest it in U.S. stocks. And if all of a sudden there's demand for this to go the other way, as we started to see on Friday, and then we saw it again on Monday and also on Tuesday, if there's demand for this to go the other way, now those markets that have been bulled up by leverage can quickly begin to come undone. And I think that's why the Trump admin began to walk back that desire for a weak USD. It wouldn't surprise me to hear the admin be a little bit more evasive around the topic in the next week or two. Now, on that, we're going to get data, and that data is likely going to be the next major push point. That's the NFP report on Friday. And if we do see weakness in the labor market, it's something that could pressure the dollar with the anticipation that there will be more rate cuts faster than previously expected. And this is something that could potentially trigger that carry unwind scenario. But for now, you could see this very visceral pullback retracement in dollar yen. So for next week, the level that I think matters most is this 155 handle. Because you could see where this was resistance turn support. And then this is what I talked about in my Monday article. This was the zone you wanted to see sellers defend, which they did. And then they got about 15 pips away from a major long-term value at 151.95. Since then, and again, you could see this very viscerally with the Besant comment on Wednesday morning, and then the Hassett comment on Friday. It's now pulling back and retracing right back to that prior spot. If we get above 155, door opens for a 156.25, 156.27 test, and then a 157.90 test. We get back up to 160, that's where matters get a bit dicey because that's when we've heard intervention threats from Japanese Finance Minister Katayama. That's where we have fear that Japan might react, might respond, might intervene. The risk reward on the trade gets less and less attractive as we get close to that very significant line in the sand. It doesn't mean it's going to be the top forever, but it does mean, given how the reaction that we've seen, you want to be real careful if we get back up there. On the short side of the dollar, I'm still partial to cable. I have this one in a pretty clean technical backdrop at the moment. We set a fresh high earlier in the week on Tuesday as we were getting that USD meltdown theme. And we've since pulled back. I have this right at a zone of support that I've been following. Again, talk about these in the webinar. It's 136.43, 136.83. That's still pretty fresh. So what I'm going to need to see and hear for this one to remain active is I'm going to need to see an underside wick on a 4-hour, preferably a daily chart, to show that bulls are going to respond and be able to push this back. When I get the support test, what I can do is I can go down to like an hourly chart, and then I can start to look for a breach or a break in the chain of lower lows and lower highs that's allowed for the test. We don't have that yet, obviously, and I'm recording this just a little ahead of the Friday close. So I need to see some evidence of reversal, some evidence of buyer activity in this zone before it becomes actionable. Below that, I have another zone of prior resistance. It hasn't really shown much for support yet. That runs from like 35.34 to 35.68. And then for invalidation, 135 and 134.60. Take your pick. I think both of these are pretty significant levels, depending on how conservative you want to be. If we go below 135, something's changed, something's shifted. And that scenario, I would be expecting dollar yen would be above that 156 and a quarter area, maybe even on towards 157 and a half, 157.90 pound dollar. Euro dollar. This again is another battleground area. And this is, we're seeing right now, again, just ahead of the close, where bulls are faltering, right? There was a significant breakout in this thing. We broke a bull pin-up formation that had been brewing for the past few months. It shows very cleanly right here on this chart. We had this bull pin-up formation that had been brewing for the past few months. We broke out in a big way, tested above 120, and then that's where buyers just fell out of bed. Now, again, if you look at underlying fundamentals, it's not like the European economy is rocking and rolling right now. So it's not something that seems to support such an aggressive breakout or trend. But the big question is whether or not we're going to see bulls come in and support a pullback to some of these prior supports. Now, when I looked at this on Tuesday, this was the area I was looking at for support. It's 119.19, which simply is the swing high from September 17th. This is going to play in real cool with the psychological videos that I recorded and published just earlier or last week. So let's look at what happened here on a short-term basis. See how we got that bounce from support, and then we go right up to that 120 handle, the same 120 handle where bulls had faltered before, and then we lower high. Clear example of buyers losing strength, buyers losing their drive, and then sellers starting to take over. And that's what's led to this dip, this short-term lower low. So, again, if I'm looking for dollar strength, I still think that dollar yen setup, that backdrop could be more attractive, but it's right in here at 118.04 where I think we could be looking at a pretty significant swing in euro dollar if it does come into play. That support did give a bounce, but it failed right below 120. So now the next test is this prior double top that it printed back in late December. It's like 118.04. Below that, there's another couple of key levels, and these are levels that I'm anticipating as being somewhat important. Let me see if I have it on this chart. I want to get something a little bit cleaner with only that Fib retracement. Nope, don't have it, so go off that one. Same Fibonacci retracement I've been talking about in these videos for months now. It's the 21 to 22 major move. The 23.6 retracement is what ultimately caught support last year in January and in February, led to a slingshot of a move. But in the second half of the year, it was this zone between the 764 and 786 retracements where bulls just went to die. And we grinded through there for like 6 months until eventually we were able to break. And that break was pushed by that carry unwind theme from the week before. So it hasn't held. If we do pull back, that's the major test. That's a 117.48 and then 116.86. Do bulls show up to hold that higher low? Again, if I'm looking for dollar strength, I don't know that this is the area I'd want to push it, because if we're looking at that backdrop, then I'm anticipating that we're going to see dollar yen come back to life. There's still the rate differential on the long side of the pair, and we're not near 160. So I still think that would be a more amenable backdrop for USD strength. But these supports, it's support to listen on. Right, 118.04, 117.48, 116.86. We get below that, we're dealing with a different scenario, and that at that point, I think dollar strength is going to have dollar yen pushing towards like a 157 and a half, 157.90-ish kind of area. But currencies have come to life in a very big way, and that non-farm payrolls report on Friday is massive. It's huge, and there's a lot of entry here in the headlines. So buckle up, because volatility begets more volatility. And that's what I have for this week. Thank you for your time. And as always, happy trading, ladies and gentlemen.